what happens if we look at a recession like the Fed has now said we will get in the second half of the year. Something in the economy is really broken, and this is my fear, is that it turns into a recession that lasts a long time. Yeah, so I think the Fed, again, and this is the tricky thing, is that the Fed said a mild recession. They also said inflation was going to be transitory, and we know what happened there. So I think the Fed has a huge credibility problem. I certainly don't put a lot of credence into what they say it's going to be. I mean, if they're telling us it's going to be a mild recession, I would generally price into my investments a mid-level recession, right? And so I think investors have to be aware of that. Do you trust the Fed? I mean, if the Fed's telling you this, do you think it's going to be that, or is it going to be worse than what they say? So for me, it's saying, okay, a recession's coming. The question to me is, how do we get out of a recession? The past 15 years, the Fed has bailed us out because inflation's been below 2%. What now happens if inflation's at 3% or 3.5%? Can they bail us out without causing a massive spike in inflation again, like we saw in the 80s? So it's again, it's this is now entering, to me, a phase of the stock market of investments where investors now have to be very careful. Historically, when the Fed actually even cuts rates, that's been a period where the stock market actually declines, even though right now it seems like investors would be thrilled if the Fed started to make money cheaper. The reason why historically the markets have declined is because if the Fed's cutting, something in the economy is really broken and they're feeling forced to cut. And that, again, would be a situation where I would be very nervous if we get to that point. So I think the key is, when you're getting inflation to come down from 9% or so, the initial move down will be very quick because, again, that was really inflated due to supply chain issues and other things like that. The trouble is always the last little bit. And I always liken this to, people can get in shape or I can get in shape, but how much more do I have to do to just get that six-pack, right? It's that last little bit that's the hardest to achieve. And I think for me, that's looking at the market and the economy and saying, okay, inflation should come back to 3%, give or take, but can the Fed get it to 2%? Can they get it to below 2%? And I'm skeptical on that. I think it could take years for us to get below 2% again. And that's going to put handcuffs on the Fed in terms of, if we do hit this light recession they're predicting now, how do they get us out of that? Or does it turn in? And this is my fear, is that it turns into a recession that lasts a long time. We find ourselves in this light recession, but one that lasts for potentially a year or two. So I think the Fed is probably on point to raise 25 basis points more. I think they're being a little bit more careful now because of the banking crisis. Even though we've seen that the banking crisis seems to have subsided, one of the concerns I have is looking at the regional bank ETF, the KRE. And the KRE still is showing us that we're not really out of this crisis. We're not bouncing back and getting back some of the losses that we had on that chart. And so you have to be, as an investor, someone who's very concerned here that maybe things could escalate again at some point. And I think one thing to pay attention to is Jamie Dimon recently did say that it's not over and that there are still possible hiccups in the banking system to come. And the market, again, is in this groove of ignoring a lot of these things. They ignored the Fed saying we were going to have a slight recession. They're ignoring Jamie Dimon saying this. Warren Buffett was on CNBC recently, and he said that one of his retail companies, their sales year over year were down 22%. Market ignored it. Wasn't even a headline. So there are these things that are going on right now that, to me, have me becoming more and more conservative and more bearish, while the overall market seems to be ignoring this and it's risk on. Yeah, so we saw the CPI and PPI numbers declining just a little bit, which is what the market wanted to see. I think the one thing that stood out to me is that if you stripped out the core from the CPI, the number didn't really fall much. In fact, it upticked very, very slightly. So again, the PPI number was a very good number. It told us that on the producer side, inflation is dropping. The CPI number, if you took out food and energy, it was not dropping quite as much. So right now the market's liking this. We're seeing a good risk on environment, but I want to see what happens as we get into earnings season and what happens if we look at a recession like the Fed has now said we will get in the second half of the year. So I'm not sure about the banking sector itself, if we'll have some major issues, that continue. But the one thing I do know is that when you have inflation, when you have interest rates that are at 0.25 basis points and you raise them to 5% in a very short period of time, you're going to break things in the system. The banking sector, the regional banks that we saw go under, that was just the start. To me, that was a tremor before something bigger. So I highly doubt that when they jack rates up this much, that's the only issue we have, and that somehow we're going to avoid any sort of major recession or major breakages in the economy. I'm more in the camp that this is probably a precursor to some other big things that are coming down the pike. And so when you get added volatility like this in the stock market, in asset prices, there usually is fear-driven selling, which is an overreaction, and then fear or greed-driven buying, which is an overreaction. And so there's counter-trend plays to that. So it actually has been an amazing trading environment in the stock market, even in crypto. But again, it's not for the faint of heart. You have to kind of be willing to step up when everyone else is panicking. So in terms of buyers, what I've been saying is to buy the pullbacks, right? So you never pay up when something's gone on a run for 10 days in a row or something. Never pay up, because you'll inevitably get a pullback. The question is, where do you buy? And basically for that, what we can see is if you take the high from 2022 to this high, there's this down-sloping trend line, and then you have this up-sloping trend line as well. And what we're seeing is that those two are getting closer and closer to the same level. So for me, that creates a confluence of two major support lines. And if we were to get a pullback on gold here to basically 1925 to 1900, that would be a really good technical support to buy for that next leg up that possibly could see a breakout through the 2075 level. I do think it is a possibility. I mean, it's definitely the high end of my target. And again, we can see that gold is much closer to that double, triple top than silver is at this point. Part of that reasoning is also if we are going into a recession, then the industrial side of silver suffers while the store of safety still helps it. So it has something working against it during a potential recessionary situation. Having said that, I still think that by year end, if gold's going to make a move towards 2,300, it makes sense that you could probably double top on silver between $29 and $30. I do think silver eventually breaks out. I think most of commodities, because inflation's going to stay high for a longer period of time, most commodities do very well. But I think at least for this year, my high-end target would be that double, triple top. So I think one of the things that most investors had a hard time with in 2022 is that the miners underperformed even gold and silver so dramatically. And the reason that happened is because you had inflation that was super high, and ultimately the metal prices weren't keeping up with the inflation, right? So inflation was much higher than what we were getting out of gold and silver in terms of upside. And what that meant is that the input costs for these gold miners were skyrocketing, but they weren't able to sell gold and silver for higher prices at the time, which made their markets essentially much weaker, their stock price much weaker. That is actually changing now. What we're seeing is inflation is starting to come down while the price of metals is going up. So you actually should see a reversal now where the miners actually outperform dramatically to the upside if I'm correct that the metals do go higher. So I think they will play catch up, and I think, again, a lot of the metals will do really, really well. Again, if I look at GDX here, GDX has had quite the run, so I wouldn't be a buyer just yet. Wait for it to pull back maybe to this pivot high around 33.20, and then that's where you would start to nibble a little bit at that price.